Hey everybody, how you doing? Tom Willard here with Tom Willard Trading. Doing another video. This one's going to be the first video on a number of videos, probably at least a couple, if not more than that, around trade management because it's a very robust um, subject. Um, there's quite a lot to cover, and there's a lot of flexibility here, and it typically is the one of the most challenging parts of trading. And a lot of people have a very, very hard time with this and have a lot of confusion around it. And it's where a lot of the psychological elements of the game come into play due to execution or lack thereof, proper execution. And that's where the plan comes in too. So as we go further down the course series here, we're going to get more into really what is, I think, 90 to 99% of trading success, which is trade management, trading plan, trading psychology. So this is going to be the first of the series, of the parts of the series of courses uh, um, around trade management. So I got an example here. First off, let's just talk basic. Now, if you look at the previous, if you watch the previous 7 videos, the number ones on the different patterns, when you have a pattern that sets up, okay, your pattern is what tells you what your entry and your stop is. Okay, and again, I'm going to go speak fairly quickly here, so because you can watch this video as much as you want, you go back and take notes, because I would suggest, as many people told me, is they catch more of the information second, third, fourth time through as they go through it and they start to understand things. Okay, that's what's great about these videos, is you can watch them over and over again. It don't cost nothing, and that way I can, for those of you guys that are more advanced, you don't have to sit here and wait for me to talk about very basic stuff. Okay, so listen to what I'm saying. When you've got a pattern, okay, that is your signal to get in. If you get a pattern, okay, in the right environment, okay, um, the, uh, the metaphor I like to use is like a plant in a forest. It's in a nice, nurturing, right, environment with sunlight and all the things that plants need to grow. Your pattern can go. So your pattern in the certain environment with regards to multiple time frame analysis, the trend, volume analysis, voids, support, resistance, all those sorts of things we've talked about in some of the previous videos. That's going to tell you whether you've got a higher odds pattern or not. Okay, best you can guess. Now the thing is things can change. Things are dynamic. This is one of the toughest professions, I believe, out there on the face of the earth, because it is dynamic. It's a microcosm for life. You got to be able to adapt and change. That's why the psychological elements become such huge um, parts part of your success in this game. Okay, so a couple of examples here with regards to stop and your pattern. Okay, because the bottom line is, listen to me closely. When you have your signal show up, which means your pattern, okay, and your pattern should tell you immediately what your entry and stop is. Okay, you should know what that is based on what your plan is. So, for example, I got 2 patterns here I'm going to point out. There's more than that, but this is chevron. You'll see here, this is what I call double tap entry, where it comes back down and makes a low and it makes a lower low. Okay, and so my double tap entry here, okay, if I were to buy it, it would be above this high here. Okay, the tight entry would be right here of a 122.68. See, the high is 122.68, so you buy it at 122.69, 122.70. If you want to be more conservative, wait for 123. See, 123.04 is the high of this little pivot here on this red bar. You buy there and you put your stop underneath the low. 121.72, 121.65. So say 121.50 to use round numbers. So 123 to 121.50. Okay, that's $1.50 on your stop. Okay, just ballparking it off this entry. Okay, that's the pattern. Now, if you're not sure what the pattern is, again, go through the patterns. I haven't talked about double taps yet, but look at the breakouts. Same thing, breakouts. If you got a base, your stop is usually below the base. Okay, and your buy point is above the base. Pretty simple. Pullbacks, retracement entries, minor pivots, flags. It's usually above the consolidation area or below if you're shorting, with a stop on the top end if you're going short, and on the bottom end if you're long. Now you might want to give it padding, and again I'll talk about that in future videos. Because sometimes what will happen is you'll say, well, 121.65, and you notice I said 121.50. Oftentimes you'll say, hey, well, I'll put my stop in at 121.50. Or 121.40 to give it a dime past the half number. Or you may just say, screw it, 121.64. Okay, it's up to you. and your data and statistics, and you've got to start tracking these various trades to find out what works for you. Okay, so let's just use the basic entry of a penny above. So say 123, let's just round it off. 123 entry, 121.05 stop. Okay, so there's your stop and your entry. You should always know that before you get into a trade. Now the other thing you've got to know, okay, is what your target is. Because if you don't know what your target is, then you don't know if the risk is worth it, if the $1.50 a share is worth it. Okay? And so that's where a lot of the different things and the stuff I talked about in previous videos comes into play. So in this particular example, on this type of entry, okay, you've got a resistance point. If you get in here and your stop's here, you've got a resistance point here. You can see a little resistance point where it went up to about 120, what is it, 124.40, stopped, and went lower. Okay, and then you've got a more major resistance point here where these topping tails are, right around 120, say 126, 120, 126.78, 126.78, 127. So let's just say 127. Okay, so let's just say 127. So if you get in here, if I were to get in here, I didn't take this trade, okay? If I were to get in here and say, okay, my $1.50 is my stop, my entry is at 123, my target is going to be 127 for my initial lot. Okay, well, what's 127 minus 123? It's $4. Okay, so it's a $4 win. If it actually goes up and hits my target, then I'm taking $4 per share profit on that trade. Okay, so what am I risking? $1.50. Well, $1.50 three times, right? $1.50 or 150. I'm sorry, $1.50. $1.50, 3, 3, 450. Okay, so if we do the math on this, and simply take the $4 per share profit, okay, divided by the $1.50 risk, you've got what we call a reward to risk ratio of 2.67. Okay, so you're risking 1 unit, which is $1.50 in this case, to make 2.67 units. Okay, which is 2.67 times $1.50. Okay, I don't get too. It's very basic math. And again, if you don't follow that, just rewind the tape. You'll figure it out pretty quickly. Okay, so is that worthwhile? Well, if you've got a good setup, okay, typically your standard acceptable reward to risk that most people want is 3 to 1. Okay, so that should be your general. That's what the general bogey people use. If I get a certain environment, a very fertile environment, where I talked about the plant in the forest earlier, I may take a 2 to 1. Okay, if I got something that's more risky, or if it's a choppy environment, really sloppy, I may demand 4 to 1 before I take the thing, because the bottom line is that if you get into a trade that that stops you out, okay, what you need to be able to do is win at a 50% rate and still make money, ideally. And with a 3 to 1, technically, right, you could lose 2 trades and win on 1 and break even. But with commissions and slippage and the rest of that stuff, that won't be the case. You got to do slightly better. Okay, so and the other psychological thing, and I'm going to talk about this in later videos, is that just because you get in and set your target doesn't mean you're going to get out there, right? Someone may see this bottoming tail. Well, that was a big red bar at some point on that day, right? And some people don't have the stones to stay in this, and then they bail, and so they cut their winners short before they run to target. Okay. And they end up hurting themselves in the long run. They better have a higher win percentage on their patterns. Okay, and other times, what people will do is they will get out early, and then it will go lower, and actually would have stopped them out, and it'll reward them for getting out too early. And they'll say, then you tell yourself these stories that, well, I knew this time because of this, this, and this, and your mind will twist things. And what you've got to do, what I found you got to do, is you got to stick to your plan, track it methodically. Follow it methodically, track it, okay? Do the statistical analysis on it, run the what-if scenarios, and continue to morph with the market. You can't sit there and think that that the exact same thing over and over again is going to produce the same results. You've got to be dynamic. Okay, it'll work for a while, but then you got to be able to sniff out the changes, and then you'll go through what I found, a little bit of a regression in your profits. Okay, ideally it's a regression in your profits and not losing more money than you're losing normally. Okay, that's kind of the development cycle. You start off losing, okay, and then you get to a point where you're making money, and then there's an ebb and flow process even when you're making money. Okay, has been my experience anyway. So anyway, that is your target. So on this trade, if my initial conservative target is this previous high, because again, if you're in an uptrend, what are you expecting? If you're in an uptrend, you're expecting it to make new highs, right? if it's at least early enough in the infancy of the uptrend. If it's a mature uptrend, well, then you're probably your aggressive target is going to be the previous highs. Okay, but something that's in the midst of an uptrend, you can expect that it'll go higher. So what you do say, okay, my initial conservative target is 2.67 times my risk. Is it worth the trade? Yeah, do it. Hit your target, get out. If it stalls before your target, then you've got to follow your trade management plan. Do you trail stop? Do you pivot trail stop? Okay, do you go down to a smaller time frame and trail stop? Do you go to a higher time frame and trail stop? Do you use a Fibonacci retracement? Okay, as a gauge. All these things I'll talk about later. Okay, I want to keep this as simple as possible. We're already 10 plus minutes in. Okay, on this one. So you follow your plan, you take it as your target, and then you ride it up. So now let's use this example here on the flip side, on Chevron. Now you can see the moving averages here, the 20 and the 40 and the 200. Here's the 200. Okay, 20 and 40. You'll see things start to get kind of toppy here, right? Comes down, the 20 rolls over underneath the 40, and we've got a lower high, right? High, lower low, lower high, lower low. First, okay, pullback, retracement from this lower high. Okay, so this you could look to short. It's below the moving average rollover. It looks like it's going to the infancy of a downtrend, start of a downtrend. Okay, so now since we've covered entry point based on your pattern, stop based on your pattern. Okay, now let's talk about targets. We already talked about the initial target. There's really two major ways that I set targets. One, previous highs or previous lows if you're shorting, which is going to be this example, or what people call oftentimes an equal move, where an issue will move pivot to pivot in equal amount from an absolute dollars and cents perspective. And it's amazing how this works out often. And it's a good gauge for a ballpark target if you're looking to go beyond previous moves. And this is going to be a perfect example of it here. So let's follow. Down she comes, retrace. Look to short it under the red bar here with a stop over the topping tail. Okay, so you're looking to short it under 124.45 at a stop of 125.68. Okay, and again, give it 10 cent, 15 cent cushions on either side, whatever you want to do. There it hits. Okay, so you're in the trade. Now it comes up, big volume. Now notice the spike. Okay, 125.70, 125.68. It went out and took out that top by 2 pennies, and I see this happen often. So if you had your stop to the penny, you would have gotten taken out there, which is fine if that's your stop and your statistics show over a statistically significant sample of recent past that that is the way for you to make money in the long run. Okay, that's what you need to do. Even if it didn't work out, even if you get clipped to the penny and then the thing turns around and goes your direction, you can't say, oh, see, this is crap. You got to say, okay, well, this is one trade that's part of a statistically significant sample that I'm building, okay, that I know that based on the last sample I had, at the end of the day, I'm going to be making money. That's all it is. It's not about winning every trade, guys. It's about winning money at the end of the day after a certain number of trades and something you can bank on. Okay, but you're staying flexible and open-minded to changing as things morph because the market does change. Now look at this thing. It goes out and takes that out. So now, if you're like I said, what I typically do on these is I give them at least, in this particular, especially with Chevron trades, 25 cents to 30 cents. So I tack that on, okay, to the stop area. So for example, this is close enough to the 126 number, and those whole numbers can oftentimes bring in more sellers. So I'll put my stop slightly above the whole number in a case like this sometimes. Now, you got to work that into your reward to risk calculation, okay, to see if it's even worth taking the trade, all right? And that'll help you keep you out of trades if the stop's too large, if the return for your risk isn't worth it. And if it isn't, then you really shouldn't take it. But notice this thing, and this is why I include this, because it came up and it clipped that by 2 pennies. And then she came down viciously, okay? Right back down. Now, so entry here, stop here, okay? You may have gotten stopped, okay? You may get back in, depends on your pattern or your plan, okay? Now, where are your targets? Because this is the last part of this video I want to talk about. Well, a couple of things. One, you've got support here at 122, where it previously hit 122. And notice it corresponds with this area here at 122, all right? Now, that's a pretty solid support area. Okay, now if you get in at 124.50, say, just again using round numbers to make it simple, and you got to stop at 126, okay, 124.50, 120, that's $1.50 to make $1.50 to make 250. Not very good. Not even 2 to 1, right? Not even 2 to 1 to this point. But here's the thing you got to look at. Say, okay, now you go back to the Head and Shoulders video I put in. This is the possible making of a larger Head and Shoulders, and this is the neckline at 122. So you think, if you're thinking from that perspective, you're thinking, crap, the last thing I want to do is be covering when it hits the neckline, and if it breaks the late line neckline, people that are doing Head and Shoulders, that's when the people are going to be piling in on the short side. In essence, you were doing what I call front running the macro pattern on the smaller time frame. Beautiful thing to do. So typically on this, I'll have the stones to hold on. I'm looking to add to the position instead of cover conservatively, even though it shows two solid support points at 122. Because it's so supporting that if it breaks, okay, when the levy breaks, down she goes. Okay, and notice that really from this time frame perspective, if you waited for the neckline break, you didn't really get a decent pattern on the daily chart. Okay, and if you ran into it there, then you're basically running a $4 stop because your pivot's way up here. If you want to just get into the neckline, which you could do, but then you got to get $12 out of the thing to make it worthwhile. And I mean, is it possible? Absolutely. Okay, you've got a pretty good tradable void down in this area here, down to the support. But why not get in for a tighter stop, get a lot more return for your bang for your buck, return for your money, and ride old girl down. Okay, so a really beautiful example there of the things. Now, target-wise, remember what I said? Here's your conservative target, and I said in this case, you see the rollover, you see the macro Head and Shoulders. You want to look for the neckline break. What could be your next target? You can say, okay, well, look at this move from 130 to 122. That's an $8 move, pivot to pivot. Okay, so that equal move concept I talk about, all it is doing is doubling down the next pivot. So where's your next pivot up? Here, right in this area, 120, say 126 for round numbers. Well, what's 126 minus 8? Right, 118. So your next target off of equal move concept, based on this pivot move from here to here, being equal to this one from here to here, is 118. And notice it corresponds to this support area here on 117. Okay, so let's just say 118, and if you got it at 124.50 with a $1.50 stop, $1.50 stop to make 124, that's $246, $6 for $1.50. That's a hell of a good return. Daddy signs up for that one. Okay, and there it is. Hit it. Okay, and as we know, it went lower. Okay, so very, very nice example there I wanted to share with you around the targets, okay, support and resistance. Let's do one more example here real quick. Express Scripts. Another equal move concept. Okay, let me back this up. Now notice this thing has been strong. Okay, real sloppy in here, kind of bottom. You can see the moving averages kind of playing tag with themselves, up and down, up and down, up and down. Comes up, breaks above this high here. Okay, sets in a thing. Now you don't really have any reference points here to the left at this point. No resistance points, right? We go to the weekly chart. You'll see that basically, you know, it was breaking out over the 80 mark, right? So right here, you can say, well, 80 is that resistance point on the weekly chart from way back in the early part of 2014. Okay, but technically it may be obsolete because of the fact of all this dancing around it did below that, clearing people out from a resistance standpoint. So when you don't have a reference point, say, hey, what's my next target? The equal move concept really helps. Where's your last pivot move? Well, hell, it's from 69 to 78. That's 69 to 79 is 10, so 69 to 78 is, again, $8 or $9. Okay, now here's your entry point. Okay, comes up, it bases along. It's basing, 5-day, 6-day base, green bar on strong volume, tight red bar, buy it over the high right here. Here's your entry over this break. Over 78.25 with a stop at 76.50, say. 76.50, 77.50, 78.50, that's $2. Say about $1.75, $1.50 to $1.75 stop. What's your target going to be? Equal move concept. $9 or $8 move. $8, remember, off the pivot, so you got to go down to the low here, 70, say 77. 77 and 8, right, is 85. So 85 off your $78 entry, right, is $7. Say $6 to be conservative. $6, and you're risking about $1 to $1.50 to 2. That's definitely over 3 to 1. Take it. Take the trade. There's your target, but then hold on to that bad boy till it hits your target. And look at this thing. Where did it hit? 85. Good Lord. Equal move. Boom, boom. All right? Use it. All right, guys. Hope you found this useful. Went longer than I'd hoped, but hopefully you get a lot of use of it. And again, we'll go into we'll explore this more in depth in following videos. Have a great rest of your week trading, and have a great new year. Happy New Year, actually, now that it's January 3rd.